For decades, the world believed China's rise was unstoppable, a country that went from bicycles and rice fields to bullet trains, megacities, and factories powering the planet. Many assumed it was only a matter of time before China overtook the United States as the world's top superpower. But then something shifted. Growth slowed, the housing market cracked, debt piled up behind the scenes, and suddenly the unstoppable Chinese economy didn't look so unstoppable anymore. Now here's the strange part. Despite all these warning signs, China still reports growth numbers most countries would dream of. So what's really going on? Is China collapsing? Are the numbers unreliable? Or is this just a normal slowdown before another surge? Today, we're breaking down the hidden reality behind China's economy, the debt problem few fully understand, and why the world may have underestimated how serious this situation could become. And before we dive in, if you enjoy deep dives into global economics, investing, and financial power shifts, make sure to subscribe to Investor Economics and turn on notifications. We cover the stories mainstream headlines often miss. Let's begin. Back in 1980, China made a decision that changed world history. A small fishing town called Shenzhen near Hong Kong was given special economic privileges. Foreign investment was allowed, market reforms began, and manufacturing exploded almost overnight. At the time, Shenzhen had just a few 100,000 people. Today, it is one of the world's largest megacities and a symbol of China's rapid transformation. And it wasn't alone. Across the country, cities expanded at unprecedented speed, with skyscrapers, highways, ports, and rail systems rising in record time. Hundreds of millions escaped poverty, global companies rushed in, and consumers worldwide benefited from cheaper goods. For decades, it looked like an economic miracle with no ceiling. But underneath that success, something dangerous was forming. China's system became heavily dependent on constant growth. Governments, businesses, and households all assumed expansion would continue indefinitely. After 30 years of rapid success, it's easy to see why. The problem is, no economy grows that fast forever. China once expanded near 10% annually. Today, it's closer to 5%. To most countries, that still sounds strong. But for China, it's a major shift because the entire system was built around much faster growth. Imagine building your financial life assuming a 10% raise every year, bigger house, bigger loans, higher spending. Then suddenly that drops to 5%. You're still growing, but your entire structure starts to strain. That's what China is facing. One clear example is the so-called ghost cities. Entire districts filled with apartments, malls, and highways were built before demand existed. Some eventually filled, but many remained largely empty. Now another major issue is emerging: population decline. For the first time in modern history, China's population is shrinking. Fewer births mean fewer workers and consumers, while the elderly population grows. That creates a long-term strain on growth, housing demand, and public finances. Because who buys the apartments if the population stops growing? Who drives consumption? Who supports retirees? And this is where the pressure builds. Debt, massive amounts of it. Official national debt doesn't fully show the problem. The deeper issue sits with local governments, which borrowed heavily to fund infrastructure, housing, and industrial expansion based on one assumption: future growth would cover the cost. But when growth slows, that assumption breaks. Estimates suggest local government debt alone may exceed $20 trillion. Unlike central governments, local authorities have limited ability to bail themselves out. Even worse, many relied on selling land to developers for revenue. When the property market collapsed, that income stream dried up almost overnight. This is where companies like Evergrande became symbolic of the crisis. Developers borrowed aggressively, built aggressively, and relied on endlessly rising property prices. Homes became investment assets rather than just places to live. When the market slowed, liquidity dried up. Projects stalled, debts piled up, and unfinished buildings appeared across the country, some even abandoned because completion was no longer economically viable. At the same time, China invested heavily in global infrastructure through the Belt and Road Initiative, funding roads, ports, and railways across multiple countries to expand influence. But not all projects succeeded. Some nations struggled to repay loans, others pushed back politically, turning what was meant to expand influence into financial and diplomatic friction. Inside China, state-owned firms also continued borrowing heavily to sustain construction and industrial expansion. When you combine government, local, corporate, and household debt, some estimates place China's total debt load at nearly 300% of GDP, an extremely high level for any major economy. And then comes another complication: deflation. Unlike inflation, where prices rise, deflation means prices fall. At first, that sounds positive, but economically it signals weak demand and slowing activity. When prices fall, people delay spending, expecting cheaper goods later. Businesses earn less, wages stagnate, hiring slows, and investment dries up. This becomes especially dangerous when debt is already high, because debt doesn't shrink just because prices fall. It becomes harder to repay as incomes weaken. China's property sector felt this sharply, accelerating financial stress across developers, banks, and local governments. Meanwhile, China faces rising competition from countries like Vietnam, India, and Indonesia, where production costs are lower and manufacturing is shifting gradually away from China. For decades, China dominated global manufacturing through low costs and scale. But as wages rise and growth slows, maintaining that advantage becomes harder. Now here's where things get controversial. Many economists don't just debate China's growth, they question the data itself. Measuring China's real economy is difficult. Local officials often face pressure to report strong numbers because career advancement is tied to performance. This creates incentives to overstate growth. In some cases, regions may exaggerate results repeatedly to avoid showing decline, creating distortions that accumulate over time. Even some officials have acknowledged that local figures can be unreliable. At the same time, China's size and complexity make accurate measurement difficult, even without political pressure. So while China remains a massive economic power, there is ongoing debate about how strong its real growth actually is. And that uncertainty matters globally because China is no longer just another economy, it is central to global trade, supply chains, and markets. A slowdown in China affects commodities, manufacturing, shipping, and financial markets worldwide. To be clear, none of this means collapse is inevitable. Predictions of China's downfall have existed for decades, and many have been wrong. China still has major strengths: industrial capacity, infrastructure, a huge domestic market, and strong manufacturing networks. The government also maintains tight control over banks and capital flows, giving it tools many other countries do not have. But the challenges are real: slower growth, high debt, demographic decline, property instability, weaker consumer confidence, and geopolitical tensions. The most likely outcome may not be collapse or dominance, but something in between: years of slower growth and structural adjustment. And that alone could reshape the global economy, because when the world's second-largest economy changes direction, every country feels it. If you enjoyed this breakdown, subscribe to Investor Economics for more deep dives into global markets and economic shifts. And leave a comment below: do you think China is heading toward collapse, recovery, or something in between? Thanks for watching, and we'll see you in the next video.